So today's topic is introduction to company accounting. So what are we going to learn in this? We are going to learn about shares. If you buy shares of a company, you get ownership rights in that company. So this depicts or shows or conveys ownership rights in a company. Then the shares can be issued at higher price, that's called premium. If the shares are issued to existing shareholders of the company, it's called rights issue. And this rights issue, they sell at discounted price. So this that is the difference between bonus issue and rights issue. Bonus issue is again the shares are given to the existing shareholders or issued to the existing shareholders, but this is bonus issue. Okay, there's no price in the sense the shares are given to the shareholders in such a way, like if suppose I hold 2 shares, I get 1 extra share as bonus share. Okay, but this is given by the company to the shareholders, like as a instead of giving dividends, cash dividends, the company issues bonus shares to its existing shareholders, right? Just a second, give me a second. So these bonus shares are given by the company to the existing shareholders for free. Okay, it's kind of a gift, by the company to the shareholder instead of giving dividends. So this is given freely to the existing shareholders. Right?
So I can't hear you clearly.
Can you hear me now?
Means like if you are talking continuously, there is a break in the voice. Like there is not like that too many
Yeah.
breaks.
Now can you hear me?
Okay.
Hello. Can you hear me now? Yes. Yeah.
Yeah.
So
Just
bonus
tell me which subject. FA, right?
FAS
Chapter?
19th chapter.
Okay, thank you.
I started the class like since 2 minutes. Okay. Yeah. So bonus issue, that means the shares are issued to the existing shareholders of the company, but it is for free. There is zero cost for this. Okay, it's given freely to the existing shareholders. Now then we will be coming into this subject. What are reserves? Reserves are what, like company accumulates some amount for some particular purpose for the future, like retained earnings of the company. Retained earnings are kind of reserves in company, accumulates its like profits of every year, and they use that money for reinvestment purposes. Then we will be learning what is long-term borrowings. Borrowings are nothing but if the company have to fulfill its financial needs, it requires funds. And the financial needs are for what purpose? To run the business, to launch a product, or to start a new company, or for any expansion purposes they require funds. So the funds can be arranged in form of equity or debt. So equity we have discussed, that is share capital, and debt is what, long term borrowings. We'll be learning about income taxes. This happens to be liability for the company. Then we'll be comparing different types of business entities. We'll be also seeing what are dividends. So dividends are nothing but if let's say company's profit is $100 and they declare 10% dividends. So this profit, whatever the company has made in this current year, net profit goes into retained earnings account. So here we have $100. And in this, we deduct the dividends, that is $10. Why we deduct the dividends from this? Because this is now declared and paid by the company to the shareholders, and now the retained earnings balance is $90. Okay, so that is what is dividends. Dividends are nothing but share of profit. not the entire profit, but some part of profit is distributed amongst the shareholders. And the reason why company distributes this dividends to shareholders is like to keep themselves motivated to continue with the company. Now we will be seeing the pro forma of a statement of profit or loss of a company form of organization. It starts with revenue, that is sales. Then cost of sales. So revenue is also called as sales. Then cost of sales is opening inventory or stock plus purchases minus closing inventory is cost of sales. Okay, and then once you remove the cost of sales from revenue, you get gross profit. Then you add other incomes to this. Okay, and you remove all the types of costs like operating, administrative, and finance costs. So all costs you remove. Okay, and then you get the profit before tax. From that you remove the income tax expense, you get profit for the year. Okay, this is the pro forma of the statement of profit or loss. Let's go into the balance sheet now. Balance sheet is pretty simple and very easily understood thing. You know, balance sheet is all about assets and liabilities. So we start with assets here. First, non-current assets. This give economic benefits in longer period of time. That is more, it takes more than 1 year to give you economic benefits. Okay, so economic benefits can be derived from non-current assets. Okay, the time period is beyond a year. Okay, so economic benefits you will be making, but it will be not within a year, but it will be taking more than 1 year to give you economic benefits. So examples of this property is nothing but land, plant and equipment is machinery. Okay, land, buildings, you can take buildings as well. Building, land and plant and machinery. These are tangible assets as well because they have physical substance. That means you can touch the particular tangible asset. Then comes intangible assets. These do not have physical substance. This will be more in a documented form. Okay, patents, trademarks, copyrights are some of the examples. Then you have the current assets which give you economic benefits within 1 year of time. Stock, receivables, and then there can be other current assets like prepaid expenses, outstanding income. Okay, then like short-term investments. Then you have cash and cash equivalents. Okay, this cash is nothing but the cash in hand or bank what you have, and cash equivalents is of course the marketable securities or short-term investments. Okay, next. So this total of assets is nothing but the total of non-current assets and current assets. You have total of assets, and then we have total of equity and liabilities. Equity I already explained to you, that is share capital. Then if you have issued the shares on premium, you have share premium account. Okay, if at all. Retained earnings is every year company's current year profits are transferred to this particular account called retained earnings account. Then comes revaluation surplus. Revaluation surplus is if you have a property or land and its value is increasing. That means there is a increment or the value have risen up. Then what? You have made some gain. Okay, but since that gain what you made, let's say you have a land of $100,000 and after 3 years it has gone to $120,000. So there's a gain of $20,000, but this gain what you have made is not something you are going to realize. Why? Because you're not selling that property. You still want to hold it for more 5 or 6 years. So this gain what you made is a non-realizable nature gain. Okay. If at all you sell this, then that becomes a realizable nature gain. Realizable nature gain is nothing but you can show that in the income statement, that is you can show it in the SOPL. Okay. But if it is a non-realizable nature gain, you have to show in the other comprehensive income section, which is made after preparing the statement of profit or loss. Okay. Then comes non-current liabilities. Umayya, did you understand? Please tell me. Hello. Hello.
Hello. Yes, sir.
Yeah, did you understand about this revaluation surplus concept?
Yes, sir.
You understood this. You have to put in the other comprehensive income section, right? You understood, right?
Yes, sir.
So where is this other comprehensive incomes made? See, after preparing the income statement, this is profit for the year. After that comes other comprehensive income, this section. Then under that, you will be writing, I don't have space, so I'm writing here, revaluation surplus. So this is what the like other comprehensive income. Let's say your profit for the year is 100 and your revaluation surplus is 20. So now your total SO total of SOPL and OCI. That means the total of statement of profit or loss and other comprehensive income is 120. Okay, that is what it is. Now, so why they have introduced this other comprehensive income section is, as we understood that if this property which belongs to you, which is $100,000, and today you are getting a value of $120,000, the 20,000 gain which you are making, if at all this gain you realize, that means if you sell this asset, if you sell this asset to some Mr. X and Mr. X is paying you $120,000, here you are making $20,000 profit, and this profit you are getting as a cash in your hand. So this is called realizable nature gain. And this can be shown in SOPL, statement of profit or loss. But if at all, so I will say this as profit on sale of asset. But let's say if at all you are not selling this asset, still you are gaining, the property value is increasing, it will be called as non-realizable nature gain. That will be showing in other comprehensive income section, OCI. Okay. Okay. So this OCI, where it comes, I have explained you right now. This comes here under the like profit for the year. I have written other comprehensive income section. Okay. And then under that I have written revaluation surplus here 20. Okay. Under this heading. And then 100 plus 20, 120. That is total of SOPL, statement of profit or loss and other comprehensive income. Okay. Now, next point. Now, let's understand more points here. So we only covered till revaluation surplus. And one thing I would explain to you, the current year profit goes into retained earnings, and any kind of unrealizable nature gains or profits what you make, that goes in other comprehensive income section, and from other comprehensive income section you will be showing that under the equity section. Okay, that also you should be understanding. So whatever you put in other comprehensive income section should also be shown under equity. Now, why you will be showing under equity? Because all the gains what you have made you can utilize in the future for any kind of reinvestment purposes, or you have to show that to the shareholders that they have that the assets whatever the company holds belongs to shareholders, and the value of those assets are increasing, and that's again a gain for shareholders. Now, then comes non-current liabilities. You have long-term borrowings and long-term provisions. Okay, provisions are certain amounts which you keep aside for certain obligations which you may have to settle in the future. Okay, and like let's say there is a company which is into electronics. Let's say it is Panasonic company. So Panasonic company is selling some electronic goods, and these electronic goods like they know that out of whatever sales they make, 10% of the sales like become faulty, and people come to them for like claiming warranties. So they make a provision every year for that particular warranty claim. So it is a estimated amount, pre-estimated amount which you have set aside for some particular obligations which you may incur in the future, and which because it is a part of your business. Okay, so provision for warranty claims. Now, current liabilities, you have all this trade payable, short-term borrowings, current tax payable, all this you have to settle within 1 year. So all the obligations which you have to settle within 1 year is nothing but current liability. Okay, now let's move from the format into the mainstream topic. So share capital, you already have on, just a second, give me a second. Yeah, you have already understood what is share capital. This is nothing but the equity or ownership. This depicts or conveys that you have certain ownership in a company. Let's say this is a company with a capital of 1 lakh rupees. Okay, and there are some 10 shareholders in this company. Each one has invested 10,000 rupees in this company. So everyone holds 10% or owns 10% of this company. Every shareholder here, since there are 10 shareholders, and each shareholder is owning or owns 10% in this company. That is the investors' share capital in this company. Okay, now there are certain types of share capital. Authorized share capital, maximum number of shares the company may issue. So company may issue some 100 shares. Let's say it is not necessary that all the 100 shares will be purchased by the shareholders. Okay, or some people may be applying for this and they may not make the payments, or they may skip the payment, or they may forfeit their shares may also get forfeited or cancelled. Issued share capital, number of shares actually issued to shareholders. Okay, so suppose 100 shares have been or let's say I have an authorized capital of 1 lakh rupees. Okay, so maximum number of shares what I want to issue is 100 shares, but I may issue only 80 shares, let's say. So 80,000 I'm collecting from people, that is issued share capital. Okay, and the money what I'm collecting from shareholders is in 5 installments, that is allotment. So first, let's say one share value is 100 rupees. So in so not allotment, first is application. So when the people apply for shares, they have to pay the first installment 20 rupees. Then comes allotment. They have to pay the second installment 20 rupees. Then first call, then second call, then third and final call. In this way, 20, 20, 20 are collected. Okay, and many people can default these payments also. So called up share capital is nothing but after like the calls have been made to shareholders to make the total payments. If the total payments have been received by the shareholders, that is called as called up share capital. The amount of issued share capital company has asked shareholders to pay for to date, and then paid up share capital is Out of this calls, even what shareholders do, they may only make the payment for first call. They may not make the payment for second call. Their shares may get forfeited or cancelled. So only what paid up we have got, if we have got all the payments of all 5 installments here, which is mentioned to you, then we will consider them as paid up share capital. Okay, partly paid shares, partly paid money of any share is not considered as paid up share capital. So amount of called up share capital which has been paid for, that is paid up share capital. Now types of shares, then again you have to understand certain concepts here. There are 2 types of shares in a company, 2 types of holders: ordinary shareholders, preference shareholders. Ordinary shareholders are called as equity shareholders, and preference shareholders are called preferred shareholders. Why? Because they get the first preference when compared to ordinary shareholders. What is the first preference what they get? They have certain preferential rights. What are the preferential rights? They get fixed dividends, first and foremost point. So fixed rate dividends. Ordinary shareholders effectively own the business. Preference shareholders receive dividend in priority to ordinary shareholders. Yes, actually, just a second. Yeah. So, uh, so the like what happens? See, preference shares are nothing but like kind of a debt for company. It's like a debt because the dividends are paid fixed and the shares have to be redeemed back. That means the money has to be given or paid back to the preference shareholders. Okay. So henceforth, any point of time, the liability, whoever are the like lenders to the company, they have first priority when compared to equity shareholders or ordinary shareholders. That means they have to get company has to settle their claims, and then the finally whatever is left over, the residual value, the whatever the residual interest in the company is what belongs to ordinary shareholders. Or if I have to say in simple words, after settling all the obligations and claims, finally whatever is left over belongs to the actual owners of the company, who are nothing but the ordinary shareholders of the company. Here comes the next point. The ordinary shareholders have voting rights. They can appoint the board of directors through voting, and in this case of preference shareholders, on winding up receive capital in priority. That means they get their money back before the ordinary shareholders. They don't have the voting rights. No right to get fixed dividend. Receive what director decide to pay. More profits, more dividends, less profits, less dividends. Here can be redeemable at a certain date or irredeemable. That means there are two types of there are basically many types of preference shares, but they have mentioned about redeemable and irredeemable. That means redeemable is nothing but the money will be paid back. Irredeemable is the money will not be paid back. And then ordinary shares, holder entitled to all profits left after payment of any preference dividend, do not usually have voting rights. This is what we have already discussed. Then comes the fourth topic, share capital accounting treatment. So now let's go ahead into this. What is that? What are they saying? Issue of new shares. Rob company started business on the 1st Jan 2006, issuing 100,000 ordinary shares of 50 cents each. So 100,000 into 0.50, the capital is around $50,000 for 50 cents per share. Initial statement of financial position would be what? So company has the initial statement of financial position is what? The company has received 50,000 rupees in its cash account. So cash account is showing $50,000. And the capital what they have introduced is how much? $50,000. So when you make a balance sheet T-shaped form, cash, share capital 50, 50, and the balance sheet total is 50, 50. It is tallied. Okay, that's what they're showing here. Now, issue of new shares at premium. So let's say if 100 rupees shares have been issued at 120. Okay, so the actual stock price is 100, but 20 is called the premium. So where shares are issued for more than their nominal value, this is the nominal value, and this is the value at which the shares are issued. The excess must be credited to share premium account. Okay, that's what this goes into the share premium account. There's a question here. We will solve this. Very simple question, very simple to understand. So we will see how much is the nominal value of a share. So in this question, on 1st June 2006, RAP company issued a further 200,000 ordinary shares of 50 cents each. So 50 cent is the nominal value for 80 cents per share. 80 cents is the value at which the shares are issued. So 30 cents is the premium premium price. That means this is the premium amount. Okay, how this is a premium amount? Because the shares are issued at premium, that is 30 cents more than the nominal value. So what? Now we will pass the journal entry. Journal entry will be the entire issue 200,000 into 80 cents. Okay, but we will give a breakup to this. So cash what they will be receiving is 200,000 into 80 cents, that is 160,000. This is what the cash they received. So we will write how much in the cash account. Debit 160,000. Okay, that is 200,000 into 80 cents. And the breakup of this 80 cents is in such a way, 50 cents and 30 cents. This is the premium, this is the share capital. So 200,000 into 50 cents is 100,000. So we will write 200,000 into 50 cents, that is 100,000. And then this premium 200,000 into 30 cents, that is 60,000. Which will go into the premium account. 60,000, 200,000 into 30 cents. So this makes sense. So debit and credit totals are the same. Okay. And when we go into the balance sheet, share capital 100,000, share premium account 60,000. You will write it as in the outer column 100,000, 60,000, and the total here happens to be 100 and just a second. Share capital. Okay, there was some previous capital as well, right? 50,000. Okay, that we cannot remove because this is the same question which we are continuing. Plus 50, that is the previous one. So 150 plus 60, that is 210,000. Okay, that is what is the answer for this. Let's move further. There comes the bonus issue. I have already explained you about bonus issue. This is used when a company wishes to increase its share capital without needing to raise additional finance by issuing new shares. So company is not issuing shares for extra money. They only want to increase the number of shares, increase the share capital. So here the company is having some wish. They want to increase the share capital, but they don't want any additional finance from issue of shares. That means they are issuing the shares at free of cost to their shareholders. That means if there are 100 shareholders, for every 2 share, if they want to give 1 bonus share, that means 100 shareholders will get 50 shares. Okay, that means 100 for 100 shares, it will be 50 shares. So now there are 150 shares in the company. Okay, now any reserve may be used including the share premium account. So for giving for a bonus issue, they have to use some reserves to show that really like some they will be utilizing certain reserves for this particular bonus issue. Now next point, bonus issue, there are some advantages. So they have to show right that some amount worth of shares they are going to issue to people. So for that reason, they'll be using some kind of reserves. So they can use share premium reserve for that, a share premium account for that. Advantages, bonus issue can be made from the share premium account which has few other users. That's what they can do. This will allow the share price to fall. Of course, now what will happen after the bonus issue, the share prices may come down without disadvantaging shareholder wealth. Okay, will allow the share price to fall to make the company share more affordable to new investors. That's what it is happening now. As after the bonus issue is done, the shares become more affordable to shareholders. Their value will come down. Okay, why will the value come down? Because some of the reserves they are utilizing for this purpose. So the amount from the reserves will be emptied up. These are all book treatments. So the reserves will be emptied up. So when reserves will be emptied up, the equity value will decrease, and when the equity value decreases, the share value also falls. Because if you want to find out per share price, the formula is nothing but equity value, whatever you have, divided by number of shares. Let's say my equity value was 100,000. Okay, and number of shares in the market was 10,000. So per share value is how much? $10. But if my equity is decreasing because one of the reserves, which is share premium account, I'm utilizing for bonus issue, now it has become 80,000, and number of shareholders is 10,000. So one share value is $8 now. You can really see that. So share price is falling, and this becomes more affordable for shareholders. Shareholders will now own more shares and could sell part of their holding. Now what has happened? Now the shareholders are getting one extra share for every 2 shares what they are holding. So if I am holding 10 shares, I may get extra 5 shares. So now I will be having 15 shares, and in future I can sell these extra shares to other people or other investors, and I can make some money out of it. Bonus issue is always done at nominal value. Bonus issue is always done at nominal value. Okay, just a second, please wait. So here I would like to tell you something. Bonus shares are free. And one more thing, bonus issues are free. It is given to the existing shareholders as a gift. So do you think if you give gift to anyone, you ask money from them? If the company is giving gift to shareholders, will they ask money from shareholders? No. So their buy price, bonus shares buy price is zero. But any share which is given to shareholders, okay, should have some value, should have some cost, right? See one thing, their buy price is zero, but they definitely have certain price. So let's say the company's nominal price is $10 for a share. So bonus shares are also issued at the nominal value, not at discount, not at premium. They are issued at $10 to the existing shareholders, but this $10 is not taken by the company from the shareholders. Okay, share may have a value, but the shareholders are not paying to buy these shares. They are getting it as a free gift or free of cost. Okay, so that's the reason why I said their buy price is zero. Okay, so now let's see after bonus shares what is happening. Now activity 2, wrap company statement of financial position extract. We already know that we had 150,000, we had a premium account, and we have retained earnings of 200,000. Okay, several years later, wrap companies to make a bonus issue on a 1-for-4 basis. That means for every 4 share, each shareholder will get 1 extra bonus share. So show how this issue of shares would be accounted for and prepare the equity section of statement of financial position of wrap company immediately after the issue. Let's see now. For every 4 shares, they will be giving 1 share, right? So once read this question, we'll be solving this. I'm giving the time to you. Hello, Maya, have you read this?
Yes, sir.
Hello. Yeah. So first and foremost thing what you need to understand is for every 4 shares, for every 4 share, the company is giving 1 share, right? For every 4 shares, 1 share. So first what we will do is we will try to see how many shares are there in the company. So $150,000 is the value of the share capital. 50 cents is the price. So we will divide this 50 cent with this. Okay.
3 lakhs.
Yeah, we know that the number of shares are 300,000. Okay. So 1 for 4, for every 4 share, 1 share. So for every 4, 1. Okay. For 3 lakhs, how many shares then? Cross multiply 3 lakh into 1 by 4. So how much it would be?
75,000.
75,000. See, for every 4 share, 1 share they are giving. For 300,000 shares, it will be how many shares? So I think 75,000 shares. Okay. So now 375,000 shares will be there in the market. But now what we'll do is we'll try to find out the value for this 75,000 shares. And we already know that bonus shares are always issued at nominal value. So 50 cents, it gives us 37,500. Did you understand this one, Umayya? Please tell me the value of the bonus share.
Yeah.
Hello.
Yes.
Yeah. So now, yeah, now we know that for issuing this bonus share, we will be using which account? Share premium account, right? We already had how much in the share premium account? $60,000. Isn't it so? Hello. See, share premium had how much?
60,000.
From this, we can use 37,500 for bonus issue, right? So 37,500. What is happening? Share premium account is always a credit account actually, but we are debiting this account. Debiting is nothing but we are reducing some value from this, and the value what we are reducing is 37,500 because this value worth of bonus shares we are going to issue from this account. Okay, and from this account we will be removing this and we will be crediting to which account? Share capital account. Are you understanding?
Yes, sir.
Because the bonus shares are shares, right? They will be added up to which account? Share capital account. Correct or wrong?
Yes, sir.
Hello.
Hello.
Are you able to follow me?
Yes, even I'm answering.
Yeah. So the share premium account is debited because from this much amount has been utilized for bonus issue, and the share capital account is created because this much amount worth of shares now will be added to share capital account. So the shares are how much? 75,000 only, because 75,000 into 50 cents make it 37,500. Okay. Now let's go into the balance sheet and do the needful there. So share capital now 150,000 was already there, and now 37,500 extra got as added because this is bonus shares. Bonus share issued. This was the share capital previously. It will be 1,87,500. Premium account already from 60,000, 37,500 has been removed. So the premium account has 22,500. That's the reason why it has this amount has been removed from share premium account and has been added to this has been removed from share premium account and has been added to share capital account. Added here and subtracted here. That means this got debited. This will be credited. This is in the case of journal entries. So don't get confused, because in journal entries only that treatment will happen. And retained earnings, it already had 200,000, right? This is as it is. So we'll put that here. Retained earnings 200,000. So 1,87,500 plus to 22,500 plus 2 lakhs. It makes it to how much? 4,10,000. Okay, this is the balance sheet. So Umayya, now what we'll do is in the next session we'll start from here, rights issue. Okay, so today you follow till here. Hello. Hello. Hello, can you hear me, Umayya?
Yes,
Hello.
sir. Hello.
Yeah,
Hello.
so tomorrow we will start from rights issue. I'll close this chapter by tomorrow itself. Fine.
Yes, sir.
Okay. Thank you. Please follow till here. Tomorrow I'll wind up the chapter. Thank you.
Thank you.
Thank you.